Okay, well, welcome everybody to the March 10th edition of Dashboard Diagnostics. I think we're in for a little bit of a, again, as you guys, most of you know, I see a lot of familiar names that we'll do slightly different things from time to time. So tonight's session will be a little bit different in a good way. Those of you that are new here, welcome. We're happy that you're here to join us. If you're just experiencing the technology for the first time, you can interface and discuss things with us either by raising your hand and going audio, or you can actually enter in, somebody's typing, so we'll have to mute, guys. Or you can actually enter into a question into or comment into the questions box, and either Lori or Ken or Kurt will pick up on that and bring it to the floor. So again, we encourage participation, either audio or by putting in questions, but let's go ahead and get started and welcome everybody. Tonight's session is, again, our Dashboard Diagnostics session, where we'll take a look at actual holdings of an investment club, looking for some lessons. Tonight's victim is the Northern Traders of Northern Michigan. It happens to be a club that Lori Fredrickson does have some affiliation with. It's also a club that happens to be near the top of the groundhog standings for our current active contest, stock picking contest. And I just threw a little, that's a Northern Trader there on the left. Everybody before the session was trying to figure out what the graphic was. And I assume that's a trap that he's setting there on the right-hand side. And it's a friendly beaver or a groundhog there in the center. But the Northern Traders hail from the Traverse City area, and those of us from Michigan are actually quite fond and quite proud of the western coast and just a whole bunch of wonderful destinations. Most of us vacation there. Lori and the members of Northern Traders, most of them live right in that Traverse City area. It's really a neat place, and that's the purpose of that cover photo from their club website, just showing a sunset over Lake Michigan.
Mark, Chuck has his hand up, so I think he's probably saying there's another lake and another coast, right, Chuck?
You got it.
And you're in this club too, right? So you represent.
He's in our club too.
Yeah, Chuck is from the Bad Axe contingent portion of the club, so a little bit different part of the state, but it's equally
He has the sunrises. We have the sunsets.
He gets the sunrises. There you go. All right, let's talk a little bit about who the club and who they are. Northern Traders. They are from Traverse City, Michigan. Right now, it's 5 ladies and 4 men. They do have some that apparently participate long distance. I assume Chuck comes in via an online connection. Is that a good assumption? Okay.
Yeah.
Because that's about what, 3-hour drive to get up there, Chuck?
Yeah, he's muted again.
He's muted now, huh? Well, the club is relatively new, and that's where we're going to go tonight. I'm going to talk a little bit more about this. This club is a little bit unusual in that I think the majority of the 9 participants to date have experience in investing or other investment clubs, so that makes them a little bit unique. But again, they haven't been around that long, so we thought we'd use it as an opportunity to talk about, well, what is really important? What should relatively new investment clubs be talking about? You know, things like how many stocks. How should we think about diversification? You know, what type of things should we be thinking about beyond just the selection of stocks and the care and the maintenance of a portfolio? This particular club, like many clubs, is a club that does welcome visitors, and you guys are taking in interested guests. Is that correct, Lori?
Yes, that would be fine. We're about 50-50 new and experienced. Mm-hmm. We have some brand new people.
So again, if you're a Michigan resident, because they are restricting it to Michigan residents right now, I believe, probably just to keep the accounting simple, if I had to make an assumption. But if you'd be interested, they certainly would love to hear from you. And again, you can attend from the, sitting by your fireplace in your pajamas at home if you want to. All right, we are going to talk about some real stocks, their actual portfolio. So again, just our standard disclaimer and reminder that anything we talk about should not be construed as an investment recommendation. Everything we do here is for education. So this is an educational demonstration. Well, let's start by talking about the portfolio itself. We do this for every club that we cover in Dashboard Diagnostics. We're not going to spend quite as much with the details of Northern Traders tonight, but we basically take any investment club as we're doing a profile of the club or trying to decide or do an analysis of the club. We take a look at these 3 major categories. what type of returns are we talking about according to the forecasts, how's their quality, and how is their overall growth. And we'll cover all those in greater detail. On the left-hand side here, you see that right now, well, at the time I made the slide, the middle or the median projected return for all the stocks that we cover was closer to 7%. I think that went up to 8 today, or pretty close to almost 8. So just shows you how bad, how bumpy today was in the stock market. This slide's only 1 day old, so it actually went up to closer to 8%. I think somebody said it was 7.8%. So that's how much a 200-point swing in the market can do to the average return expectations for any stock. Here's just a brief rundown. We call this the report card. The projected annual return at 12.5, the quality in the excellent range at 77. A bit unusual for investment club to have a growth that high, 12.9%. We'll be talking about that, but everything else here is fairly standard, maybe a little bit bumpier than usual. It's because they've got some fairly frisky tech stocks in there right now, but nothing to be concerned about. Just overall pretty good profile. Again, the three major categories, we want our projected annual return on an overall basis for the portfolio to be somewhere in that 5 to 10% range greater than the stock market. That's what's shown here. This range here is 5 to 10% above this middle or median. Think of it as an average if you want. Average projected return, and you can see that they're there. They're right at the low end. They're in the target range. Same is true for quality. Quality is fine. During this portfolio would typically behave fairly well in a bear market or a correction. It's not to say it wouldn't lose ground, but it should behave relatively fairly well. And then last but not least, in this one they actually are overperforming a little bit. They've got smaller, faster-growing companies, so they're actually at the high end of the target range. Which, again, if it was my portfolio, my dollars, and I was doing the investing, I would lean a little bit towards some of the bigger companies, the slower-growing companies, just to kind of balance this out. But again, this is a real nice condition to have. Real nice position to be in. So again, high marks pretty much across the board. Let's talk about sector diversification. There's a pie chart showing that they are spread out fairly well. You'll notice that there's a big no or do not use or don't go there warning over the top of this. And the point I'm making here is, again, this is a relatively new club with relatively few stocks. You really don't want to certainly not worry. Somebody asked the question, how much should I worry, using the specific word worry about sector diversification, particularly as a new club? My answer to that would be almost not at all. I mean, I don't worry about much anything, but sector diversification would be one of the last things I would ever worry about. And again, you don't want to ignore it, but at the same time, you don't want to obsess over it. That's one of the reasons that we didn't have those pie charts we were kicking around before the meeting at Manifest Investing for years, because we basically wanted to do a little bit of deprogramming. Our community really is kind of obsessed over sector diversification. You don't want to obsess on it. You don't want to ignore it, but you don't want to obsess on it. So that's the reason that's whited out. This club should just worry about finding high quality, good stocks that are on sale, and worry about sector diversification specifically down the road. And even then, don't worry about it. Manage it. Here's a look at their portfolio. Again, they've only been around for a few months, so you can see that they've got a relatively small portfolio with 5 stocks. We'll be talking shortly about how many stocks are enough. But again, 5 pretty solid selections. These are all very high-quality companies. Their projected returns are pretty good. Lori, do you have a comment?
Yeah, you can see we only buy stocks that start with A. We're just moving through the alphabet.
Well, you might want to, kind of flip and do some more at random, the next time you do some. I've never heard of alphabet diversification, when it comes to portfolio design, but maybe you need to do some of that. Now, you've got, these are 5 pretty good stocks, and again, one of the reasons we're not going to talk too much about specific stocks or anything else tonight is one of the things we do encourage clubs, and again, this kind of falls into that same category. Don't worry about it, but be aware of it. This is the benchmark report that is available in the Bivio Club Accounting, and in this case, you can see that you can make a quick comparison. Again, they haven't been around that long, but during the period that they have been around, their club has generated a 34.1% internal rate of return. That's their rate of return on the portfolio, versus if they had made the same dollar investments into the Vanguard 500 index fund at that same time, that's up 21. So again, they're at a plus 13% relative return. And if they can keep that going for a few more years, we'll be reading about them in Fortune magazine, Money magazine, the Wall Street Journal. Keep up the good work. So again, our message here is measure, be aware of it, but again, for a relatively new club, and we want to focus on them even more here in a few minutes, be careful not to be too concerned. Be aware of what you're looking at. I mean, you want to do better than the average stock market, but again, just do the right things. We're going to talk about the right things. Do the right things and don't worry too much about what your return on. I will issue one caveat to that. Now, this goes to a club that I had visited a couple of years ago out in West Bloomfield, Michigan. And this club was in a nasty funk. They were basically ready to disband. They said, Mark, our return is only 4%, and you keep telling us that we got to be shooting for 15. And I said, your return is only 4%? And I said, do you realize what the average return on the stock market is since the day that your club was founded? And they said, well, no. I said, well, let's take a look. We took a look, and the average return at the time that they're having this meeting was minus 4%. So again, their 4% return, minus 4%, they actually were 8% ahead of the market. And again, over the long term, that's all you're trying to do. That magic 15% number comes from NESC co-founder George Nicholson's target of trying to beat the market over the long term. The market over the long term has a return of approximately 10%. Again, that's going back to 1940. And what Nicholson was trying to do is show the way to target and try to achieve plus 5, 10% plus 5%, or basically 15% returns. What he never intended to imply was that that would be possible over any 2 or 3 or 8 or 12-year period. You have to keep in mind, which way is the wind blowing in the stock market, and be very careful when you pass judgment about how well you're doing. I mean, you want to check. Lori, did you have a comment?
No.
Sound like you wanted to say something.
Mark,
Go ahead, Ken.
I have a question. Mark or Lori, how long does this number, how long does it represent? Is this a 10-month number, a 15-month number? How old is this number?
No, it's over a year. It's a year and it's almost a year and 3/4, or it's almost 2 years. I mean, it's getting close to 2 years.
Yeah, it's since inception, Ken, so it'd be since August 2009.
2 years in August. Yeah.
Right. And it is from inception, correct?
Yep. Yep.
Okay. Mark, Gene Lang has his hand up. I'm going to unmute him. Gene, go ahead.
Mark, just a question for a brand new club, one newer than this. Let's say a club is less than a year old. It has startup costs. For example, Bivio, Manifest if you sign the club up, a P.O. box if you choose to use that. I know that's an optional expense and questionable maybe. And then if you register with the state, for example, if you're a limited liability company, but whatever, there are going to be startup expenses which make that number IRR a challenge at the beginning. Have you seen a lot of that? How do you address that? Because you can get behind the curve. Not that they can't catch up, but it's a challenge during the first 6 months to a year.
Yeah, fair enough. Lori, I assume this number does include those type of expenses?
Well, yeah, we didn't have too many, very minimal expenses.
Well, you probably got Bivio for nothing. I'm talking about
the and we buy our own Manifest and whatever subscription, so that isn't coming out of the club.
It's an excellent point, though. What you're basically talking about, Gene, is that startup load that can definitely impair early performance. And I didn't put in any slides on this because I'm going to be talking about, we're putting together a presentation called Investing on a Shoestring. And it's relevant to your question, Gene, because I can remember back in Chicago, we'd only been a club for a couple of years. I can remember fiercely trying to hold down expenses so that our expense ratio would stay low. And part of what we'll talk about in that is, do what you can to keep that expense ratio, again, the amount that you pay in for research or whatever tools divided by your total assets, you want to keep that as low as possible, because it obviously comes out of the return.
Yeah, I just offer that as encouragement to new clubs. The key is that we've been gaining on that number. It's been getting better and better with each month, even though the latest club I'm referring to is only about 4 or 5 months old. So
right, yeah, and it might take a while, and that's something that, again, as investors, part of what investment clubs should be teaching all of us is sometimes sometimes it takes a while, and
and it's okay, because if you're starting, and if you're starting and you're trying to learn, you're not going to be as good at the beginning either. So, this is we lucked out, frankly, with our IRR. We happen to have Chipotle, which we just got rid of, but we happen to hit a home run real close to the beginning. So, if we can maintain this, you're right, it will be totally amazing. But
all good points. And again, that's some of the reason that I kind of give that answer to don't even look for a while, because you shouldn't be worried about that for a while. For example, in the club accounting, depending on who you use, I don't think they even calculate the annualized rates until the stuff has been around for a year. And the reason that they do that is the numbers are just way too weird until you get some time under your belt. So
yeah, that's an important thing to think about too.